In this video, I'll go over everything you need to know about investing with index funds, and we're starting right now. Hey guys, Elliot here. So as a financial advisor, if I could pick one investing approach for the typical small investor, I would recommend index funds. But why exactly, and what's so special about them? In this video, let's go over the details of what index funds are, and pretty soon I think it'll be clear that they need to be a major part of just about any investor's portfolio. First off, to understand an index fund, you need to understand what an index is. In the world of finance and investing, an index is nothing more than a listing of stocks or bonds grouped by some common theme. Indices of various types exist, and in all cases, their purpose is to measure market performance and provide real-time information to the financial and investing industry. The best-known index in the world is the Standard & Poor's 500. Just simply referred to as the S&P 500, this stock market index tracks the stock performances of exactly 503 of the largest companies listed on stock exchanges in the United States, totaling over $40 trillion in market capitalization. Second and third among the major indices in the US are the Dow Jones Industrial Average, which tracks 30 major blue-chip companies, and the tech-heavy NASDAQ Composite, which tracks more than 2,500 stocks listed on the NASDAQ stock exchange. Worldwide, there are also a number of very well-known international indices, such as the Nikkei in Japan, FTSE in England, DAX in Germany, Sensex in India, and the Hang Seng in Hong Kong, just to mention a few. All these indices do the same thing. They track the top stocks listed in their respective countries and give a snapshot of the overall state of the market. So when you hear in the news that the Dow or the S&P 500 closed at a record high, you know it's been a good day on Wall Street. Without an index tracking and reporting the collective state of hundreds of companies, it would be hard to assess the big picture. Most of the major indices, including the Dow, NASDAQ, and the S&P 500 here in the US, are what's called capitalization weighted indices. That just simply means that the companies they track are assigned a weight as a percentage of the total. This is figured out by calculating a company's market capitalization, which is their share price multiplied by the outstanding shares. Then that number, whatever it may be, is compared to the total index market capitalization, and voila, you get a percentage weight. It's similar to weighing every fifth grader in their homeroom class and listing the weight of each one as a percentage of the total class weight. You're welcome for that comparison. Okay, so you're a newly minted expert on the stock market indices and are now by far the most interesting person at the dinner table. But what does all this information on indices have to do with index funds? Well, it turns out the relationship between indices and index funds is a very direct one. Index funds are simply mutual or exchange-traded funds that contain the exact same stocks and in the same proportion by weight as those tracked by the reference indices. In other words, an index fund literally mirrors the index it is related to, but while indices only track stocks and display information, index funds actually purchase and own these shares in large quantities. When the fund expands and takes on more investor money, they simply buy more of the same shares as in the index while maintaining the same proportions by weight. Now here in the US, it's hard to talk about index funds without immediately going to the S&P 500. Because the S&P 500 tracks the largest companies listed in the US and essentially presents a snapshot of the entire American stock market, the majority of available index funds are tied to that specific index, and this is where you, the investor, comes in. With the background information we just covered, we can now discuss why it's such a good idea to invest in these funds, and there are several very important reasons. Perhaps the biggest reason of all is diversification. When you invest in an S&P 500 index fund, you're essentially investing in the total large cap stock market. And since its inception in 1957, the S&P 500 returned an annualized average of 10.13% and greatly rewarded those who stayed in the market. The second biggest reason to invest in index funds is simplicity. An index fund strategy is literally the definition of hands-off passive investing, which is exactly how the majority of US retail investors prefer it. You don't need to pick any stocks and just invest in the total stock market. It's a strategy that not only pays you well, but is also extremely easy to understand for novice investors or ones who don't have the time or desire to pick stocks. Related to simplicity is low cost, and this is reason number 3. Index funds are one of the least expensive options for investing, as there's no fund manager to pay and all stock selections are done automatically by a computer algorithm that simply matches the fund's holdings to the reference index. Once per quarter, rebalancing is needed as the S&P 500 is a dynamic listing with stock weight percentages changing or even companies entering and exiting the index on occasion. But again, this is all done automatically, keeping investor costs very low. So hopefully you see now the huge advantage you get with index fund investing, and to no one's surprise, many pensions, 401ks, and other retirement plans all invest heavily with index funds, and odds are high that your plan at work at the very least offers that option. So how do you invest in an index fund if you're planning on doing so on your own? And what funds are out there? Well, it's very easy to buy into a fund, and dozens of major index funds and ETFs are out there from companies like Vanguard, Fidelity, BlackRock, Invesco, Schwab, and State Street Global Advisors, among others. You can open an account with any of these directly and link your bank account to transfer funds and begin investing. You can also buy through an online discount broker such as TD Ameritrade, E-Trade, Robinhood, TradeStation, or whoever you happen to use. Here are a few names in the index fund and ETF world to get you started. These are not endorsements or recommendations, but rather I'm just letting you know what is out there so you can do your own research. Among the biggest players are the Vanguard 500 Index Fund, ticker symbol VFIAX, the Fidelity 500 Index Fund, ticker symbol FXAIX, the Spurdy S&P 500 ETF Trust, ticker symbol SPY, and the iShares Core S&P 500, ticker symbol IVV. Feel free to check them all out by Googling the ticker symbols. There are, of course, many more funds out there, most following the S&P 500, but other indices as well, including the international ones, and there are also index funds that follow bond indices. In all cases, look for the lowest expense ratio possible, with 0.03% considered good. Also, check if there are investment minimums. There may not be a set dollar amount, and one share will be the minimum. Now, of course, you can't discuss index funds or really any investment without listing some of the negatives, and index funds do have a few. Probably the biggest is that index funds don't try to beat the market or seek alpha as is known on Wall Street. Because these funds mirror the index they track, their performance will, no surprise, be exactly matched to that index. So if anything, they are the market. If your strategy is to beat the market, you really need to either pick the stocks yourself or invest in managed mutual funds where a skilled fund manager will try to buy only certain stocks that they feel will outperform the rest. Whether or not they end up being correct is the risk you will end up taking, along with the much higher expenses since someone has to pay for that expertise. Another negative is that since you can't pick specific stocks, index funds are not for those who wish to invest in certain industries, sectors, or execute a certain strategy. With an index fund, it's really all or nothing, with you having no say in the specific stock holdings, only how many shares of the fund you wish to buy. Finally, it's important to mention that investing with index funds carries with it no downside protection. If the market is sinking, your holdings will sink along with it. Index funds are often described as an ocean, with you, the investor, being a ship on the waves. If the ocean rises, so does your boat, and the opposite is true as well. Fortunately, when it comes to the stock market, over the long term, the ocean is always rising. With an S&P 500 index fund, you are investing in the total market, and you're placing your hopes on the ingenuity of our society to come up with and market new products, solutions, and services. And in that regard, we have never failed ourselves. No matter what global events throw at us, including several world wars, a few crashes, and a few pandemics, the market just keeps going up, and index funds with their singular mission and low costs are the perfect investment vehicle to capture this success. So that was a quick overview of index funds. I hope you really enjoyed this tutorial and got a lot out of it. If you did, please do consider subscribing to the channel. It helps me out a lot, and I will see you in the next video.